Have you ever stared at a stock chart and just felt completely overwhelmed by the absolute chaos of green and red candles flashing before your eyes? I mean, it's incredibly easy to let emotions take over when your hard-earned money is actually on the line. But what if you could replace all that anxiety with a cold, calculated step-by-step process? Well, welcome to this explainer. Today, we're laying down the ultimate blueprint for chart analysis, entries, and exits. We are going to completely transform how you look at the markets by giving you a logical framework that's designed to strip the emotional chaos right out of your trading. Okay, let's dive into this.
But first, before we get to the fun stuff, I need to state this clearly. Markets are subject to risk. Please do your due diligence before investing. This video is for education purpose only. This does not guarantee any returns.
All right, here is our roadmap for today. 1. Identifying the big trend. 2. Spotting high-probability setups. 3. Mastering the entry rules. 4. Defining your exit strategy. And 5. Essential risk management rules.
Let's jump right into step 1, identifying the big trend. Think of market trends kind of like a giant staircase. A bullish trend, that's essentially a staircase going up. It creates higher highs and higher lows. The buyers are very clearly in control here. Conversely, a bearish trend is a staircase going down, characterized by lower highs and lower lows, which means sellers are dominating. You always want to trade in the direction the staircase is already pointing. If you look at the green stair-step pattern, you'll notice how every single peak is higher than the last, right? And each valley is higher than the last. That is your classic uptrend. Now look over at the red structure. Lower peaks, lower valleys. That's your downtrend. You know, here is a surprising fact. Most amateur traders actually lose money because they try to predict trend reversals instead of just following the current momentum. The golden rule here, pulled straight from our source material, is super simple but incredibly powerful. The trend is your best friend. Identify it on a higher time frame like the daily or 4-hour chart, and you immediately stack the odds in your favor.
Moving on to step 2, spotting high-probability setups. To do this safely, we actually use a mandatory 4-step sequence. Honestly, you should treat this exactly like a pilot's pre-flight checklist. Step 1, confirm the trend is in your favor. Step 2, wait for a pullback, meaning the price needs to retreat to a key level. Step 3, look for confirmation, like a specific candlestick pattern. And finally, step 4, the actual entry. If even one of these steps is missing, the whole setup is invalid. You stay grounded.
Seeing this checklist play out, you can clearly spot the uptrend at point 1. Then, point 2 hits, the price pulls back, dipping right down into that green support zone. Now, this is exactly where amateurs usually panic, but it's where the pros really pay attention. At point 3, boom, we get our confirmation. If you look closely at those volume bars at the bottom, see how the volume spikes right on that confirmation candle? That is institutional money stepping in, telling us the setup is absolutely primed and ready for step 4, the entry.
Okay, step 3, mastering the entry rules.
So here is your ironclad entry checklist. First, you wait for that pullback. Then you're looking for confluence. Basically, multiple factors like support levels or moving averages all lining up together. But the absolute most crucial point is this third one. Wait for the confirmation candle. Patience is literally everything here. You do not just jump in early because the price touched a support line. No way. You wait for the candle to close, enter on the breakout of that specific candle, and immediately place a logical stop loss. Notice that massive green candle completely swallowing the smaller red one? That's a bullish engulfing candle, forming right near our volume weighted average price or VWAP line. That right there is our confirmation. But look exactly at where the blue buy line is drawn. The entry happens only when the price breaks the high of that bullish engulfing candle. If it never breaks that high, you just never enter the trade. It's really that beautifully simple.
Which brings us to step 4, defining your exit strategy.
This breakdown of a professional trade plan is brilliantly defensive. When the price hits target 1, you don't let greed take the wheel, you take a partial profit, usually around 50%. Then, as the price approaches target 2, you move your stop loss right up to break even. The logic here is fantastic. By securing those partial profits early and moving your stop loss, you effectively eliminate your risk. It basically becomes a free trade. Your initial stop loss, as you'll see at the bottom, always goes below the pullback low for a long trade, giving the market some room to breathe while still protecting you from a sudden trend reversal. And once you're sitting in a risk-free position, you can bring in a trailing exit. What this means is you simply move your stop loss below the new higher lows as the uptrend keeps going.
This technique is exactly how the pros capture those massive market moves. It lets you let your winners run, confidently locking in profit along the way, all while strictly protecting your capital if the market suddenly turns on you.
Finally, Step 5. Essential Risk Management Rules.
Listen, if you take absolutely nothing else away from this explainer today, please burn this number into your brain. 1 to 2%. You should only ever risk 1 to 2% of your total account capital on any single trade. No exceptions. Why? Because there's a really brutal mathematical truth in trading. If you lose 50% of your account, you literally need a 100% gain just to get back to break even. Keeping your risk small allows you to survive the inevitable losing streaks, so you can actually stick around long enough to capitalize on the big opportunities.
Let's quickly run through these non-negotiable risk parameters. Always use a proper stop loss. Ensure your risk-to-reward ratio is at least 1 to 2, meaning you stand to make twice as much as you're risking. Never move a stop loss further away once it's placed, just to avoid taking a loss. Absolutely no revenge trading after a bad day. And do not, under any circumstances, average down on losing trades. Protecting your capital is just vastly more important than proving to the market that you are right about a stock's direction.
To tie everything we've built today together, there's this incredible quote straight from our source material. Plan your trade and trade your plan, not your emotions. You see, consistency doesn't come from some magic indicator. It stems entirely from discipline. Waiting for the right setup, taking the trade, managing the risk, and just repeating the process.
So I want to leave you with a bit of a challenge. Are you ready to let the market teach you? Are you ready to prioritize this step-by-step analytical process over the desperate chase for immediate, overnight profits? Chart analysis isn't a get-rich-quick scheme. It's a continuous learning process. Start focusing on executing the blueprint, and the results will absolutely follow.
Please like, subscribe, share, and comment if you want to see more strategies.